There's a new. Did you see the new graphic? I'm even further ahead of you now.
Yeah, you're
right. It moved me higher. You've been demoted, Robert.
This is literally going to. It's a formal protest now.
Yes,
formal protest.
Welcome to the special edition of the Tradiers, the Trader's Edge. I'm Jim Uriel. That's Bob Iacino. We have some great guests coming on, but one quick question before we go. Today, copper gets hammered, gold gets hammered. Platinum hung in a little better than I thought. Is this big deal, little deal, just position squaring? The fundamental story's not changed. When you looked at the initial volume, it wasn't as strong as you would think for such a large move, specifically in copper. So from that perspective, I'm going to look at it as more people protecting profits, speculators getting out. You know, the China threatening the EU with tariffs, I thought was sort of a deceleration of the economy story, and that might have spooked some people. If we never got China mentioned, it spooks copper. But outside of that, I don't think the UK inflation numbers are enough to derail copper. So I think the trend obviously is still intact in a very big way. You thinking about buying any more? I am, as a matter of fact. I mean, I don't do it on the first day. You know, the typical way that I do things is something collapses, I look for a rotation back up and see that sort of support got confirmed. I think it is going to get confirmed. By the way, the weekly, we're really far away from any support in the weekly. So it can go a lot lower and still that trend will be intact. Good. Now, you guys, I say this every week. I'm going to say it again. You guys may think Bobby and I are full shit, blowhards, whatever you want to think, it's fine. But you cannot deny that we get the best guests. And today it's almost funny. This is going to be such an easy show to do. We're going to ask like 2 questions and let 2 of the Titans slug it out if that's what they want to do. We have 2 guests. We have Cameron Dawson, Chief Investment Officer of New Edge Wealth, who 2 years ago when I first met her and she was coming on her show, since it's an androgynous name, I thought it was a dude named Dawson Cameron, actually. And to my surprise, it was not. And we also have Jim Bianco, who is the president of Bianco Research. Bobby, what were you going to say? Well, I thought it was a woman named Bianca James. That's not true. Right. You are lying. But here they come.
Hey, guys.
Hey, how are you?
What's up, guys?
So, you know, I got a bone to pick with you. You having this on the open because we're going to get NVIDIA's earnings
right now. Do you have a speed up?
Yeah, and you know, like I said, NVIDIA's earnings are otherwise known as the open here. Everything until now has been, you know, kind of pre-open trading until this moment.
I have both my things here showing me, waiting for it because it could. I mean,
so Bobby, we're going to have a 50-handle move here in about 30 seconds. Which way is it going to go?
It's going to turn around. I think the Nasdaq's going to turn positive on the future side of things. I don't, you know, NVIDIA being so freaking important and so freaking large. I mean, I get it. But I think the fundamentals, man, I think we're still in a reflationary environment. And I have a question, but I'm just going to shut up because you 2 are here.
Well, no. Okay. Because as long as we're talking about this, let's start with Cameron. I like to talk about the big AI thing. So I just read Larry McDonald's new book, which I thought was mind blowing. And he talks about, you know, the next 20 years possibly being this inflationary period where, you know, we could be running 3 to 3.5% inflation, and that growth will not be the place to be in. Hard assets, the things that Dennis Cartman used to say hurt when you drop them on your foot. And I am long all those things, but I am still long some of the AI stuff as well. Cameron, where do you fall out? Is the AI thing overblown at the moment, price-wise?
We're still pretty early on in this, and we could be overblown in the short run price-wise, but still be underblown in the long run in how the trend will actually play out. But I think it may not be one or the other. I think the bigger question is, are we going into a commodity super cycle that looks like the early 2000s? Because if you're going to make a own value kind of argument and don't own growth, then that's effectively the call that you're having to make. And, you know, I think that Barry Bannister has done great work on those big commodity super cycles of where commodities trade relative to equities. And are you near a low in that? The challenge with that is that you could be a year, 2, 3 years early and still there be a big cycle, but still be early to these major turns and trends. So a lot of it depends on your call for a dollar. Remember, the dollar fell by 35%, I think, over the course of the early days of the 2000s. You had huge exodus out of capital flows from the US that led to this value trade, non-US trade, deflating of the growth trade. So at this point, you could have both. I wouldn't be so far to say that you should throw out all your growth stocks and jump into value. But I do think that there's still a good argument to make for having commodities, having exposure to more value-oriented parts of the
James, do you think we are at James? It was very formal. You deserve that sort of formality.
His name is Bianca. Okay.
Bianca. Bianca, what do you think? Are we at the beginning of a commodity super cycle?
I think we are. I think that really what happened was the old cycle, the disinflationary deflation cycle ended in 2020. And so Larry McDonald's book, I'm right with it, that we are turning higher into more of an inflationary cycle. And I completely agree with him. When I say, so you got to be careful. People think inflation's a loaded word, right? When you say, I think we're going to have inflation, they think Zimbabwe. And I'm thinking, no, like 3.5% inflation. And that's a problem. You don't need Zimbabwe to have it become a problem. And so, yeah, I do think we are in that up cycle. Now, within that, what's also happening with commodities too is I used to work with a guy named Howard Simons for many, many years. And he had a great line where he used to say, copper, cocoa, coffee, crude oil, and corn all start with the letter C, but they don't all belong in the same index because they're all completely different from each other. And so when you talk about a commodity super cycle, yeah, the general trend of all the commodities are going to be up, but don't confuse copper, corn, and crude oil. They're all very, very different. That one or two of them could be in a different cycle, like a bear market, while the general trend of commodities is higher. So yeah, I do think we are in that kind of cycle. And probably the headline when it comes to the inflationary super cycle probably is gold. And with its move higher over the last several months, that kind of underscores that idea.
So Jim, can you have a commodity super cycle without goods inflation? I mean, I think we've had them in the past, but given the current environment, can that happen?
I think it's hard. I think because commodities are about goods inflation in this point, so if you're talking about, I heard Jimmy talk about, our friend Gartman talking about dropping stuff on your toe. Goods are things you could drop on your toe too. And so if you're going to have copper and you're going to have crude oil and you're going to have some of these other things moving higher, some of the industrial metals, it's going to feed into, ultimately goods inflation as well, because the inputs for goods is these raw materials. And it's just going to make the base for that to make those things even more expensive.
One thing on that point is that in the 2000s, you had this massive commodity super cycle. You had the BCom up almost 100%, actually about 100% over the time from 2000 to 2007. What's interesting is that, yes, non-durable goods saw inflation. They were up in that period about 24%. But durable goods actually still saw deflation because of globalization and because of technology. But durable goods are a much smaller portion of the overall CPI bucket than non-durable goods. So it's a question of, if you have a commodity super cycle, but you also don't have a globalization super cycle at the same time, which is what we had in the 2000s, do you still see that kind of durable goods deflation that you had? Or is technology enough to bail it out and say that you could still see that kind of big, huge downtrend in durable goods? I think it's a big question that remains to be seen, that would be different this time than the 2000s cycle.
Well, so then the question that we need to ask, and let both of you take a crack at it. You first, Cameron. No, so I always argue that Paul Volcker deserves some credit. Reagan deserves some credit for breaking down the walls for globalization. But the internet deserves a hell of a lot of credit for breaking part of that inflation cycle that was going on. Right around the time we started to get out of the inflationary cycle, the internet came, did its deflationary thing. Is AI powerful enough over the next 3 years, let's say, to be the deflationary technology? Dramatic pause. I love a good dramatic pause, by the way. I like it a lot. I come with a big punch.
I think the last time you made me dramatic pause, we put the meme up of the dramatic.
Yes, it was a great meme.
I mean, I think this time it would show up more in goods. I'm sorry, in services would be my initial reaction. Is that is there disinflation or a cap on inflation in services because of AI? I would point out that in durable goods and in non-durable goods, AI could potentially make manufacturing processes more efficient, But my counterpoint to that is that this process has been going on for a really long time, and it's more incremental step changes. I used to cover the industrial names, and back in 2014, it was big data. And everybody talked about how big data would allow you to do predictive maintenance. And that's happening now with technology. It's finally coming to life where you're able to predict downtime for machines, so you can run machines more efficiently, which again feeds into your manufacturing process, maybe makes you a bit more efficient, but doesn't necessarily suggest like direct disinflation. So I guess you would look to the services side, but Jim, do you think that actually makes, so do you think AI is going to feed its way into services disinflation anytime soon?
No, I completely agree. I think that the internet and the availability of information really pushed itself into goods and helping to make the efficiency of goods, finding goods, trading goods, getting goods, moving around the world in a more efficient way. That was the internet. That's a 30-year-old technology right now. That's your father's technology. AI, I completely agree, is going to be more about services, and it's going to be more about making services, I want to say more efficient. And the implication about services is that they're going to become, that those prices are going to fall. But let's also remember there's, Northwestern University, there's a professor, Bob Gordon, in the economics department, and he's written a number of books about new technologies. And what he basically says is a new technology is a net creator of jobs. And you can see that all over the place, that every time we create a new technology, two things happen. The first thing that happens is everybody goes, oh, look at all these jobs we're going to lose because they're going to be automated away or something. And that's true, but it opens up the door for whole new industries, whole new businesses, whole new business models. Who knew when when Steve Jobs held up the first iPhone 1 in 2006, raise your hand if you said that's the end of the taxi cab business in 4 years because of Uber, or that's going to completely rechange the way that hotels work because of Airbnb. So I think what AI is going to do is it's going to take existing businesses, existing business models, existing jobs, and it's going to really squash their costs down. And there is going to be millions of jobs in whole industries that have yet to be created that are going to come on the other side of that. And so, yeah, it's going to be a big, big change, I think, for the services sector. And, what are those new jobs going to be? They're probably going to be more intellectual and content related because so many service sector jobs are about doing things. But now we don't have to do those. The computers can do them. Now it's going to be about thinking about things and about doing more stuff, in content and intellectual property.
Cameron, on May 20th, you wrote stocks celebrated slightly cooler than expected CPI data, suggesting that inflation, while still elevated and sticky, is not hot enough to push the Fed to hike rates further. Was there anything in the minutes, if you got a chance to look at them, that make you deviate from that a little bit, or no?
Yeah, it was the call of saying we didn't think that they would hike rates further over the next two meetings, right? Sure. And that we know that the Fed is going to be data dependent. Nothing's surprising about that statement. One of the things we've been thinking is that there is a much higher bar for further rate hikes than there is a bar for rate cuts. We still don't expect rate cuts. We don't think the data supports it, and for a whole host of reasons. The first one being is that the Fed has never initiated a rate cutting cycle in the midst of an expanding PMI. And I know PMIs dipped down in April, but if you look at things like South Korea exports, Japanese machine tool orders, all leading things for PMIs would suggest that there is still a recovery, an acceleration in some cyclical parts of the economy, which would then suggest that the Fed has zero historical precedence for going about us initiating a rate cutting cycle, given that backdrop with that data. Now, if the data changes, then that's where we would say, look, like if we think that they'll react very quickly to a weakening in the labor market, whereas we don't think that they'll react as quickly to a reacceleration in inflation, which is not a bold statement to say because we've seen the reacceleration in inflation and they didn't react. They actually ignored it for 3 months straight before even acknowledging that it existed.
Yeah. So Jim, to that point, we do see PMIs kind of maybe not screaming higher, but rounding for sure. I mean, they're no longer decelerating as a whole, especially in the U.S. And you have Jerome Powell kind of leading the markets in the direction of expecting at least one cut. I think as of this morning, the CME Fed Watch tool had 2 cuts, or maybe one. 2 days ago, they had 2 cuts.
One and change.
What's that? One and change.
Like
Yeah, there you go.
34.
One and change. I see nominal GDP somewhere around 5%, 5.5% nominal. And when I look at that and I see the Fed funds rate at 5.25, and they say rates are restrictive, do you disagree with that statement? I don't think rates are restrictive.
Yeah. I mean, if you look at the data, and if I was to hand you some data, the current data, and take the name off of the economy and say, here's the data for the U.S. economy, what do you think Fed policy should be? And I'll give you the funds rate. I don't think anybody would say, oh no, the Fed's got to start cutting rates. The only reason we're talking about this is because the Fed keeps talking about this. Mm-hmm. And that's the only reason that rate cuts are even being considered, because a data-dependent Fed, which they say they are, shouldn't be looking at this data and talking about cutting rates. Now, we can debate whether or not they should be raising rates. That's a different question altogether. But I think the only reason that one and change and that 6 rate cuts back in January was ever on the table was because the Fed continues to talk about this. So yeah, when you look at nominal GDP, I share your thought that we're in the 5 range. I think that, there's a discussion that needs to be made at the Fed as to what is the neutral funds rate. And Powell came out at his last press conference and kind of reiterated the company line that 2.5% is what you would consider neutral. Neutral being, what is the rate of the funds rate that neither stimulates or restrains the economy? It's the long run expected inflation rate of 2% plus 50 basis points, 2.5 or thereabouts. But it's more and more looking at, some Fed officials have come out that said, no, you know what? The neutral funds rate is probably closer to 4 to 4.5, meaning that the Fed only has 2 or 3 rate cuts to get back to neutral, not 12. Rate cut being 25 basis points, not 12 like Powell is talking. So why does Powell keep, I think, talking about rate cuts, even though the data doesn't warrant it? Because he thinks that there are 12 rate hikes too many over neutral, because he thinks that 2.5 is the neutral rate. But if he starts thinking, no, wait, maybe the long run inflation rate is 3, and maybe it's not 50 R star, which is what we refer to as what should it be over the inflation rate? It's not 50 basis points. It's more like 100 or maybe a little bit more than 100 basis points. Then you get into that 4 handle for a neutral funds rate. And it makes sense too, because 5.25 to 5.5 is restrictive, but it's not that restrictive if you think that the neutral funds rate is around 4, which explains why the economy just keeps advancing despite all this, hand rubbing about high interest rates restraining the economy and restraining inflation. It's not because they're not that punishing that they, like the Fed thinks they are.
Is it? Hold it, Cameron. I want you to, before you answer, I know you have something, and I want to just weave this into it. Is it fair to talk about a good economy and not talk about a 1 trillion every 100-day elephant in the room that is the national debt? But then say what you're going to say and then address mine.
Well, look.
By the way, Nvidia's out. Out. I hope everybody's long. Let's just put it that way. 10 for 1. 10 for 1 stock. 10 for 1 stock split, and
wow.
They beat on everything right now. So
is this where I say I was right or admit I was damn lucky?
You're in it. I'm out of it now.
Well, the question is, does it make it till morning? The move.
There you go.
Because I want to get back in, but not today.
But Cameron, what were you going to say?
Sorry.
Nvidia's up 5%.
Yeah, 5%.
It's up 5% right now.
Yeah.
Okay.
I think, one of the questions is, I should calculate this is how much Treasury saved. Probably not a lot, because coupon issuance compared to bills issuance has fallen, but how much they saved after the Powell pivot in the fourth quarter of last year, when interest rates began to fall, because Powell was talking about cutting interest rates. How much did Treasury save in that? Given the fact that they got a little bit of relief on interest rates, that seems to probably be a reason why Powell is doing what he's doing. If you're trying to come up with rationale for it, because to your point, Jim, they were actually they've been eager and itching to cut rates and pivot multiple times. I think it was back in the summer of 22 when Bostic actually started talking about, hey, we could cut rates at the end of the year in the beginning of 23, started floating it. That's when you started seeing pressure within credit markets. Credit spreads really started to widen out that summer. So there have been multiple kind of attempts at this pivot. They seem inclined to keep wanting to do it. But what's interesting is that the entire time that their rate has been technically restrictive, so the Fed funds rate over the core CPI or core PCE, the entire time that's happened, the U.S. economy has grown above trend. It actually hasn't been a positive real rate based on that measure for more than a year. It only went positive, I think, in July of last year, and it's still not nearly as positive as it was back in the 2000s and in the 90s, where it was sustained at a much higher positive rate for much longer. So the fact that they've been talking about this for so long is just fascinating, because there's just no precedent for them to be as easy as they think they'd like to be, unless, to your point, Jim, that they're just way understating the neutral rate, which we think that they are.
Deutsche Bank did a study on this late last year, and they refer to what we're in now as the 7th pivot attempt by the Fed since 2022. And I guess if they just keep doing it long enough, eventually they could get it right once and then proclaim that that's why they're the professionals, right?
Neither of you two have addressed, Jim, the debt. Why in the world, what kind of Keynesian nightmare are we in where they're doing this spending as if we're in a depression, and then at the same time telling us the economy's great? How do you reconcile that?
But by referring to you as Comrade Uriel, and that the government is going to run everything. Two things about the debt and about the debt. The first thing is debt to GDP is, deficit to GDP is running at around 6%. So to put that in perspective for everybody to understand, let me back up a little bit. The U.S. government right now is spending about $6.25 to $6.5 trillion a year. That's about 23% of the economy. So a fifth of our economy is the government taking our money and spending it. About 73% of that 6% number that they're spending is covered by taxes. The other 27% they borrow, which is that deficit to GDP number of around 6%. Now, what's interesting about those numbers is when you talked about, Keynesian kind of a economy, we are, a pro-cyclical Keynesian thinking in the government. In other words, when the U.S. economy goes into recession, spend like crazy to try and stimulate it out of recession. But when it's growing, you're supposed to pull back, and then kind of save your powder for the next recession. Well, 22% of spending being in the U.S. economy and the deficit at 6%, we're spending more today in the fourth year of a recovery than we did in most recessions over the last 50 years. At the worst part of every recession, the government wasn't spending 22% of the economy. It wasn't running deficits of 6%. The two exceptions were the worst of the financial crisis of 2009 and obviously COVID, because that was a unique situation where we shut down the economy and mailed everybody money. But right now, the U.S. government is spending as if we are in the throes of a recession. And that's one of the reasons why I've often argued that whole soft landing, recession narrative, you can forget that. There will be no soft landing or recession if the government is spending at that level. They could single-handedly prevent a soft landing or a recession. Now, of course, there's a consequence to that, and that consequence is inflation. That's, this isn't a free lunch. Just let the government spend. Everybody gets a job. Everything goes up. You also have inflation being the other side of it. How does it end? Mike Wilson talked about this on his piece over the weekend. He's a Morgan Stanley strategist. We referred to it as the Liz Truss moment. In 2022, Liz Truss was the prime minister of the UK. She's a Tory, a conservative, and she put out a budget. And the budget was, we're going to cut taxes, we're going to increase spending, we're going to blow out the deficit in the UK. Parliament, their Congress looked at it and said, well, we're cool with this. Let's do this. But their bond market, the UK gilt market, was not cool with it. It blew up. It, the Bank of England has 300 years of data on their interest rate market. The worst day and the worst week in those 300 years was in the fall of 2022, when the bond market imploded on itself, so much so that it created what was called the LDI, or liability-driven investing crisis, because the financial market couldn't handle that big a move in interest rates. So I know how this is going to end, that the bond market's going to put its foot down and it's going to say, you're done spending, and we're going to take rates to 5% or 6%. And politicians will say, well, it's too important that we keep spending for these reasons. Okay, we'll take them to 7%. And politicians will say, well, okay, we'll take them to 8%. Should I keep going? Because I will, until you freaking stop spending now.
Hold your cards.
Yes, I know how it's going to end, but let me say this. I don't know when. Is that later this year, or is that in 15 years, or somewhere in between? But what I'm trying to say is, there is no Jefferson and Hamilton we're about to elect anywhere in the horizon that's going to say, let's all agree to rein in this spending. If you want Biden, you're going to get $6 trillion of spending over there. If you want Trump, you're going to get $6 trillion worth of spending over here. You're going to get $6 trillion worth of spending. It's not going to go away until the bond market's ready to make it stop. And for right now, it doesn't look like the bond market's ready to make it stop.
Just a quick question to Cameron: Is that the recipe for a long-term steepener? I've had steepeners on and off this year and have made some money. I don't have anything on right now. Does this curve steepen out?
Well, look, maybe. The thing is that it depends on Fed's reaction as well, and the timing of how things react. I would imagine so. I mean, the question is, what if you get these dual things happening at the same time? Let's say it's August timeframe, right? We're going into Jackson Hole. The Fed starts talking about the neutral rate, and they're having a more serious discussion about the neutral rate being higher. In theory, that should raise some questions about how the long end of the curve is priced. At the same time, is that we've just gone through the conventions, and neither party's talking about austerity. Neither party's running on an austerity platform whatsoever, which just means you get that $6 trillion on both sides that Jim is talking about. We had a pretty big move in the bond market at the in the third quarter of 2023. Do we have another big move in the bond market where yields in the long end do pop higher? I wouldn't rule it out. What's interesting is that there's a lot of analysts, and there's been a lot of analysts calling for a top in yields. At the beginning of this year, when yields were closer to 4%, people said they're going lower, and they're going to keep going lower. People said yields have a 3 handle, or even are going to target 3%. Our view at the beginning of the year was that yields were biased higher. Now you have a lot of people saying, well, the April high in yields was lower than the October high. Yields are in a topping pattern for the cycle, and they're not going to move higher. I'm still in the camp of not so fast. And that, yes, you can look to extended duration in certain places in building a portfolio. But if you're just making a call on yields, I wouldn't be surprised if that bias higher continues.
So we go through periods of time where we have to be experts on things for a short period of time. And what I'm talking about is, I like this comment, by the way, from Lewis. Taxpayer money is going from taxpayer to the big companies like NVIDIA. That's why the market keeps going higher and consumers hurting to pay bills. I asked them to put that up because I think that's what most people feel, whether it's technically correct
corporatism
or
world
not.
we live in. I mean,
yeah,
all these companies get
correct
shit tons of taxpayer dollars, whatever. Yeah.
Anyway, what I was talking about, Cameron,
Stop with the technical language, Jim.
what I was talking about is we become experts in things. So like in 2016, we had to be weather experts because there was a big hurricane season in the Gulf. Again, in
I'm from Florida. I'm a weather expert always.
Well, you were born a weather expert, but yeah, weather and alligators. So
and
that
cheap
happened
beer.
again. And what?
And cheap beer.
Oh, cheap beer. I love cheap beer. Then it came to the point where we were expert in jolts. Like we all had to pay attention to jolts. In the oil patch, it was rig counts a few years back. Half the people had never heard of Baker Hughes rig counts, even though they'd been reporting them.
I thought of getting a Baker Hughes rig count session once, but
Sure. Now I think people are starting to tweak their knowledge of supply disruptions. And I'm wondering if this is to both of you, but Cameron first. Liberty Economics, which is a research arm of the New York Fed. And by the way, all you guys watching, you can get the New York Fed's research. You can get any Fed's research just by signing up for it. They said this: May 2024 supply disruption, about a third of services firms and 48% of manufacturing firms reported at least some difficulty obtaining the supplies they needed over the past month in response to special questions focused on supply chain disruptions in the New York Fed's May business surveys. Then they compare it to the high stress point in 2021. But then down the bottom, it says 23% of service firms and 38% of manufacturing firms indicated they raised selling prices because of supply disruptions. Cameron and then Jim, do you guys worry about that rearing its head again? Or is these not numbers that matter?
I mean, look at the prices paid in the ISM. It was the only thing that came in hot. New orders was weak, employment was weak, but both services and manufacturing prices paid jumped a lot higher. The question is, was that because of the blip we saw in some of the supply disruptions? Not a blip, it's still ongoing, but you saw a spike in container shipping costs, for example, given what was going on in the Middle East. The question is, does that continue? I mean, the thing that's interesting in all of this is that transports broke down today, like really hard. Road and rail stocks look ugly. Freight prices still look ugly. And that's not to say that, that's the perfect litmus test, but typically in supply chain stress environments where people are grappling to get things, if the stuff is out there and there's stuff to move, but you just have to pay up for it, you would typically see it show up in freight pricing, and you haven't. So this is not 2020 or 2021. It has a very different flavor, but I wouldn't ignore those prices paid line in the PMIs.
Jim?
So let me just point out, Bobby, don't forget that we were all pandemic experts 4 years ago.
Hell yeah.
So we're whatever you need us to be an expert on, we could be an expert on.
Don't
but I completely
politics.
agree. Yeah, exactly.
Politics, the Middle East.
Right,
I don't,
right.
Max, can you put up Eric's comment? I sort of agree with what he said here, since there's a pretty heavy Chicago contingent here. Sorry, Cameron.
The correct answer is not Luminati's, Eric. It's just not.
Well, I think he should have put what's the best deep dish pizza, and then that's arguable. But people from Chicago don't order deep dish pizza like every 2 days.
I was going to say I don't eat deep dish pizza, but then again, I'm also not 400 pounds either. So that's why you don't eat. That's why we don't eat it.
Yeah, Pat's Pizza with the tavern style with the real crispy crust. That's one of my favorite pizzas.
So we have some of that style pizza here in New York. Ace's Pizza is amazing if you want a thicker crust and Emmy squared. But I think it's
let's get Dave Portnoy on the case.
Yeah.
By the way, before I ask, Jim was going to answer a question. Have you two ever met each other before? Have you two been on shows together?
Well, yeah, we've spent some time in a canoe.
You went fishing together, so you're genuinely.
Yeah, we went fishing together. Yeah.
Why were we not invited on that trip? Anyway.
Obviously,
you don't cut it, Jimmy.
It's not hard to figure out why we weren't.
In the pouring rain, I was frozen. I think I got pneumonia from that trip.
Pictures, it looked awful, except for the fact that you two were there.
Yeah, but we did our some pretty big damage on top of a perch hole. So
yeah.
That
was a lot of fun.
Yeah, the butcher's
the perch hole.
Yeah.
Man, you are a Chicagoan. You got to get out and get a fishing
different in my old neighborhood than it probably meant on a fishing trip. Jim, you were going to answer that question, Bianca.
Yeah, I was going to agree with. I was going to agree with what Cameron said, and I just throw out that if you look the IMF Port Watch the IMF has a new website called IMF Port Watch, and they track the daily movement of ships around the world through the 7,000 ports. And if you look at that data, what you're seeing is a big drop off in the amount of goods being moved around the world because the Red Sea is closed and they have to go around Africa to go from Asia to Europe. And there's low water in the Panama Canal. What does that mean? A container ship is really a shuttle. It just basically goes back and forth between Asia and Europe or Asia in the West Coast of the United States 6 times a year. Just goes back and forth, all it does. And if it has to take a longer route, it now can only make 4.5 runs a year, not 6 runs a year. So how do you make up those other 1.5 runs? You take excess container shipping, and that's what we look at when we look at the spot rate for container prices. And that's what's been rising, is that excess is being demanded because these ships are taking longer routes. But in the process, we've got delays, we've got bottlenecks, we've got slow shipping. And as Cameron pointed out, it's starting to show up in prices paid, and it's starting to show up in some of the other indicators that would suggest that there is problems brewing in the supply chain. And that's what Liberty Economics was. I read the report yesterday myself as well, too, that Liberty Economics was highlighting. And a quick shout out, the Federal Reserve, I happen to think that a lot of their research is very good as far as when you read something like Liberty Economics, about what's going on with the supply chain, they'll give you excellent research about what is happening with the supply chain. Maybe their conclusion is a little bit politically oriented because of the Fed. They can only say things, but up until the conclusion, it's really useful stuff. So I would really recommend anybody to take a look at it to that point. And so, yeah, I think we are having a bit of a bottleneck with what's been happening in the Red Sea and stuff. No, it is not as big as it was in 2020, late 21, early 22, when the supply chains were reopening after the COVID shutdowns. But nevertheless, it is a problem. And it could show up later this year, especially in Europe, but more so in the United States. It could show up later this year as higher goods prices in an era where we're talking about the Fed trying to cut rates, and you can see goods prices going up. One last thing, well, that shouldn't affect the U.S., right? Because we've had, the Red Sea doesn't impact China to the west coast of the United States. No, it doesn't. But a lot of those ships were trying to go China to the east coast of the United States through the Panama Canal. They got low water levels in the Panama Canal, and they've been restricting the amount of shipping through the Panama Canal. So a lot of people have been going China, Europe, the United States, and now they got to go around Africa too. So we're getting hit by it, not as bad as Europe, but we're going to start feeling it as well too.
And I think just on that point is we should appreciate just how much durable goods deflation and non-durable goods disinflation has contributed to the moderation in inflation. So as you start to see those things stall out because of some of these measures and other spiky things stay elevated, that's when you get to your 4% stickiness in the inflation, because you're losing big drivers of disinflation and outright deflation in the goods line.
So does any of this get solved? Just a quick follow-up. First of all, is there an actual effort to reshore things, or is it just too far down the line to worry about this particular cycle of inflation and possible supply disruptions?
Well, I'll go. Yeah. I mean, there is an effort to reshore, but, you could say the words, let's reshore, but that doesn't mean it's going to happen. Intel's trying to build fab plants in Arizona and Ohio, and they probably are. We're going to make silicon chips here in the United States again in 8 or 10 years. And that's probably if everything goes well and the environmentalists don't get in their way, and stuff, but it isn't going to happen overnight. There was a great article last year about after they had all the problems when China was under zero COVID, and the Apple was looking to move more and more of the production of the iPhone out of China and into India. And the Wall Street Journal had this story that basically said, it is so complicated to understand these supply chains. We get stuff from suppliers who get stuff from suppliers who get stuff from suppliers, and we want to remove China from the mix, that even logistically at Apple, they really don't know how to do it. It's so complicated. Sure, they could move the final assembly of the phone to India, but that doesn't mean, and they are assembling more iPhones in India, but where are the parts coming from to put them together? They're still coming from China. And even if you remove one of those suppliers and use an Indian supplier, where's that Indian supplier getting his parts from? China. And so it's really difficult to reshore. Yes, it can be done. When I say difficult, it's time consuming. That's what I meant. It can be done. It probably will be done. But don't think that this is going to be something that's weeks or months or even a year or two. This is something that it will take a very, very long time to try and sort out with the reshoring.
The trade war started in 2018. It's now 2024.
Oh my God.
So if a trade war and a pandemic that shut down supply chains weren't enough to get you to be able to get over the humps of reshoring, then maybe it's just too hard to do, which means that some of these things are a bit intractable or just take a lot of time. And there are some companies who've been successful at moving as much of their supply chain as they can into localized places. But other companies, even defense companies, like US defense companies, rely on Chinese suppliers for certain parts of their manufacturing and production. It's incredibly intertwined.
So we had Vivek on our show, Ramaswamy, and I asked him this exact question. Like, if we are going to be cutting out China from this whole equation, we're talking about decades of a lower standard of living than we had grown accustomed to. It's just not that easy a thing. And he had and I like the guy a lot, but he had all these things we must, whatever. Is the question just, Jim, I guess I'll ask you, can we just make nice with China and go back the other direction if it proves to be insurmountable, or could we ever even do that?
I don't think we need to cut China out of the equation. I think what we need to do is make a credible threat that we would or that we are, and then they'll start playing nice. They'll start realizing that they don't have that monopoly control that they think they have anymore. That if they don't start playing nice and we're starting to reshore or moving more towards friendlier confines like India or Vietnam or something like that, then they'll start saying, look, we can't be doing the things that we currently do right now, like demanding any US company that does anything in China that they demand to see all the intellectual property that they're doing. They demand to see all the patents that they're using so that they could steal them. And we have acquiesced, many companies have acquiesced along the way. It's well known that in China, if you're talking about an iPhone or if you're talking about Motorola, there was this big story about this many years ago that Motorola was building some phones in China, and across the street literally was another factory that was building an exact ripoff of the Motorola phone to sell in China. They were basically just stealing the intellectual property of Motorola, and they were just basically ripping them off to sell a lower version in China. But Motorola tolerated it because they wanted those phones made at a cheaper level in order to sell to the rest of the world. China could get away with that. I don't know if in the future they can get away with that, but first they have to realize, you're in a competition with everybody else. Right now, they don't think they are. They think that they're kind of running the show. And so, no, we don't have to completely disengage ourselves from China. We just have to credibly disengage ourselves to get them to play by the same rules that everybody else plays by.
The same thing happened with Cat. Cat goes in, builds a huge business in the 2000s, sells all these excavators. Then all of a sudden in the 2010s, China starts undercutting them in price and domestically made excavators, and their China business, even though China was building new things, just goes poof. Same things happened with Starbucks, right? And you come in, even though that's not high technology, but still it's the same rinse and repeat strategy over and over. And I think it's a good question, Jim, if they can keep doing it.
My father used to refer to Starbucks as the rape of our culture. But my father thought every single thing was invented in Italy. So it doesn't even matter. He would call it all theft. Just real quick before we have to let you guys go. And I'll go Cameron, then Jim. In the context of this rally that we've been in, I said earlier in the show, I think we're in a reflationary environment, which means assets up, inflation up to me. That's what it means to me. What would you call what we're in? Is stagflation more of a risk? Is it reflation? What would you call what we're in?
I'll go first. I would probably call it an inflationary environment. As I said, I thought the deflation, disinflation era ended in 2020. Mm-hmm. And I think we are now in a new era of inflation. Another way to say that is the 40-year bull market in bonds ended in 2020. We are in a many-year bear market in bonds. That's not necessarily a bad thing for stocks or for anybody else because it's an era of yield again. We got a 5% yield. We'll probably have a decent rally in bonds somewhere along the lines. Maybe it's unfolding right now, but we're probably going to start to see us go higher. I think a lot of the things we've talked about, reshoring, the end of globalization, the challenges with the supply chain, all of these things are leading towards at least goods inflation going higher. I think that on the services side, let me talk about domestically in the US. I think that the labor market has had a tectonic change since COVID, and work from home or remote work, to be more specific, is probably the manifestation of that. What I think employees have finally learned is that they had more power than they ever thought they had. Oh, I can't really mouth off to my boss because I just been lucky that I have this job. Now they're realizing, remember, about 35% of the U.S. economy or U.S. workforce has a college degree, about 35%, 65 don't. So if you're in that 65% down and you're in a non-professional job, a lot of those jobs have become a lot more transactional. What I mean by transactional is I'll take a job, I'll work, I'll, save up some money. And then in the winter, I'll go hang out with Cameron in Florida because it's cold up here. And then in the spring, I'll come back and I'll find another job and I'll do some more stuff. But don't worry, it'll take me a week to find a new job. That attitude didn't exist 5 years ago. And I think that this is what is causing the stickiness in labor, or stickiness in wages, stickiness in services, stickiness in goods. Again, as I said before, whenever you say inflation, people think it's a loaded term. Oh, no, it's not Zimbabwe. It's 3-4% inflation. Oh, what's the difference between that and 2%? It's the difference between 2 and 5% on interest rates is for a starter right there. And there's always the risk that it can go much higher as well. And lastly, Bobby, my name ends in a vol. I have an old Italian guy that was my father too. And they all think if you do a cup of coffee wrong, you've wrecked civilization.
I used to get smacked if I touched a piece of bread while there was still pasta in the plate, because you can't eat two starches at the same time. I'd literally be sitting at the table, I'd reach for a pasta, my head would go like that because I just got smacked. No words, just a hit.
I just to add a couple of things of things that we're watching for, which is that I don't think that we've seen the full impact of the rate hikes that we've had thus far because of a long tail of QE, because of a suppression of the long end of the yield curve that in an unprecedented way with lots of liquidity allowed for the real tectonic shifts in balance sheets as well, in a way where we can look at measures like the percentage of usage of commercial paper balances being far lower than they were prior to the peak, and other cycles where corporate balance sheets on the large end are just immunized versus rate cuts and benefiting in some ways versus they did in prior cycles. End result being is that we still think we have a refinancing cycle that comes in 2025. The entirety of the current treasury yield curve is above the investment grade average coupon or effective coupon today. The entirety of the yield curve, which just means that you will have refinancing, you will have a repricing of balance sheets where interest rates or interest costs will eat more into profits. And I think that's the point when you start seeing a little bit more of what's been done with Fed policy start to bite. And to put a finer point on it, which is that even if the Fed cuts interest rates, the question is, do you really see a reaction in the long end of the yield curve if inflation stays hot, if the neutral rate is actually higher, if we continue to spend on fiscal policy, which means that you might be seeing the cash rate start to fall. So what you're earning on your cash start to fall because the Fed's cutting interest rate, but you're still refinancing at much higher rates, unless you get some big flight to safety that really pulls the long end of the yield curve down. And of course, that remains to be seen in an environment where is the risk of a Liz Truss moment actually present. So it's going to be a very interesting 18 months.
Nice. When I talk to you guys, my head spins because you guys throw so many different things at me, and I really like that. Normally at this part of the show, right before I goodbye them, I say, tell them where to find you, but you guys don't need to know where to find Cameron and Jim. If you don't know where to find them by now, you're a bunch of idiots. They're everywhere. We are so lucky that you guys are here with us, and thank you so much. We really appreciate it. And thank you guys for watching. Please stay around. There's more coming on what are we calling this event that Tradier is doing?
We call it the thing.
We call it the thing that Tradier is doing, and then we're all here and we're having fun. But thank you guys very much. Good to see you, Jim. Good to see you, Cameron.
Thanks, guys.
Thank you.